This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set to rise after a fourth day of gains on Wall Street. The latest set of US economic data doing little to dissuade investors about the trajectory of anticipated Fed cuts. OpenAI releases a new AI model, one that can perform some human-like reasoning tasks. And China said to be poised to cut interest rates in $5 trillion of mortgages as early as this month.
And Haidi, we continue to watch inflationary pressures around the world, especially as we had U.S. CPI out of the way. We also got those PPI numbers picking up slightly for the month of August. We're talking about 0.2% gains month on month. And really, it was not only services leading those gains, but also shelter costs, very sticky and higher shelter costs for the month of August. Not surprising, given that we're seeing the worst housing crisis in the U.S. in decades.
We are also, of course, watching central banks more globally. We had the move from the European Central Bank, the ECB cutting rates again as inflation in that area continues to recede, and we're seeing more and more evidence of economic stumbles, lowering that rate for the second time this year. Inflation really pulling back towards 2%, and these concerns about broader economic weakness really slowing. They also haven't closed the door to an October rate cut as well. A reduction at the next meeting still looks unlikely at this point, but certainly Christine Lagarde kind of dodging those questions on the prospects of a follow-up move on October 17th.
We expect the recovery to strengthen over time as rising real incomes allow households to consume more. The gradually fading effects of restrictive monetary policy should support consumption and investment.
Those comments by Christine Lagarde really leading the early price action in the Treasury space, as well as we got some weakness in German bonds. The 10-year yield rose to around 3.70, but still below that level. We continue to follow the U.S. future space, of course, really not doing much in the Asian Open, but we did get a broad rally. It was small caps, tech all rallying at the same time. And really, the crude price still below that $70 a barrel level, but of course, we continue to follow that global demand outlook. The dollar fell overnight, and we had the Japanese yen higher on the other side of that trade. Take a look at how it's coming online, or at least when it comes to the Japanese futures market right now, because we are seeing a little bit of upside. We had seen the first rebound in 8 sessions for the Nikkei, and we're seeing futures now pointing higher. And the Japanese yen also, we saw some strength as we got another BOJ board member talking about the need to raise rates until that 1% level. Sydney futures up 0.6%. And of course, we do have a lot of data still incoming from China, which we'll be watching out closely for. Haidi.
And Shery, I know that you've been watching this one. We've also got breaking news when it comes to the Central Bank of Peru. We are seeing that reference rate cut by the Peru Central Bank to 5.25% from 5.5%. They've said that that cut doesn't imply that future cuts will be made, but that core inflation does continue to slow. So this is now the lowest level when it comes to interest rates in the Latin America area, that benchmark rate to 5.25%. Inflation in August cooling to 2.78%. So really kind of setting the runway for that path of easing, but now the lowest level among Latin America's major economies there. There's a lot of concerns with that economic rebound coming to a sudden halt. It is all about central banks. I want to bring out Garfield Reynolds, who leads the Markets Live coverage here out of Sydney. So, Garf, there's a sort of a jostling when it comes to taking in pole position in where this easing cycle is, right, and how we're going to see that potential rate divergence play out.
Yeah, well, exactly, and the biggest central bank, the one that matters, far more than others, the Federal Reserve, they're finally due to cut rates next week, and there's two things going on with the outlook there. One is that even with the way that bets on a big rate cut, a 50 basis point cut in the first Fed meeting have faded away, the Fed is still seen at the absolute minimum cutting bang, bang, bang 3 times in the final 3 meetings of this year. There's even, in fact, the 50 basis point cut priced in at some stage for this year. That's far in excess of what the ECB is going to do, of what the BOE is going to do. The RBA is probably going to stand pat. So that's the key input for a lot of investors in a lot of ways. A weaker dollar is the expectation, and that is seen as being a help for most economies. Many of them have struggled with the strong US dollar over the last 2-3 years. So that's a key point. The other key point, I think, that's helping to drive some of the equities calm and even optimism is that we've had these two risk factors on everybody's plates this week. Will the Fed go 50 basis points or 25 basis points question? That's mostly resolved. There's also been the debate on everybody's minds with the sort of the tail risk there that you would get another situation like after the first debate, Biden-Trump, where the Biden candidacy was seen as collapsing, and so you were seen as the potential for a Republican sweep, for a triumphant Trump march towards victory. Instead, investors have been able to say, okay, it looks like this is still going to be an even race, and probably neither side is going to end up with the sort of overwhelming sway that would lead them to be able to pursue their agendas fully. So those two risks have quietened right down. Investors can be a bit more certain going forward. We're going to get a close race. We're probably not going to get one side or the other getting preponderance in the way the US is governed next year. And we're going to get a Fed rate cut starting off cautious with the potential that they'll go harder if the economy slows. But sort of the good news hidden in there is that the economy is seen as doing okay. That soft economic landing is still in play. You could argue there's a soft political landing in play as well.
What does that mean for euro-dollar then, particularly with Christine Lagarde sort of holding her cards quite close to her chest about the way forward? Yeah,
well, I mean, the euro-dollar had been sliding, fairly rapidly into the ECB. There's a strong perception that the ECB's DNA is essentially dovish at the moment. So there was some anticipation that they might, be willing to open the door to consecutive cuts, seeing as it looks like that's what's going to come from the Fed. And there have been worrying signs, especially around the German economy, which is the key economy for one of the key economies for Europe. So in that setup, the fact that Lagarde did not give any hostages to fortune, stressed data dependence, there's even something in the forecast that indicates a risk that inflation will tick back up. So that makes the likelihood that the ECB will be a reluctant cutter from here, especially relative to the Fed. That should help to support the euro, both against the dollar and also against the pound, because the BOE is also seen as being a relatively slow move on the easing front. So one of the risks for the euro was that it would slide further against the pound if the ECB was going to be more like the Fed and less like the BOE.
Yet, Garfield, it seems the broader trend is downwards, right? Whether it's the BOE, the BOC, or the ECB, and now you have the Fed also joining that easing trend. And yet you have one central bank, the BOJ, that still wants to hike rates. How much of that yen carry trade has been unwound so far? And could we see more sudden, massive increases for the Japanese yen against all other currencies?
Well, we could definitely see another spike in the yen. That's something that I think helped to contribute to Wednesday's rather strange, ultimately, action where we had some severe declines in equities at one stage, but then everything ended up at the end of the US day after CPI. Yen strength remains something that's on the mind of risk asset investors, partly because it's obvious that not all of the yen carry trades have been unwound. Even if you think more than half of them have been unwound, they got to such extreme levels that that's still a lot of powder that is dry and ready to go off, so to speak. The other factor is that there's plenty of yen shorts, as it were, that are not carry trades per se, but simply structural setups. One of which is the large amount of investments that a range of Japanese institutions have abroad. When you've got a situation where everybody else is cutting, the BOJ is hiking, and part of what's going on there is the Japanese economy is doing better, at least on a relative basis, compared to the rest of the world than it has in many years. That can spur repatriation, but that's likely to be a gradual repatriation, so it's likely to keep the yen bid without it taking off. The risk is always there, though, that it could take off. And if you remember that there's been a fair bit of chatter about how the yen should ultimately end up back more like 120 or 130. So if that's the case, there's always the potential that it could make a sudden surge towards those levels, and that would be the danger.
Yeah, I mean, we are headed towards 140 very slowly, it seems, right now. Garfield Reynolds, who leads the market's live Asia coverage, with a broad view of markets today. OpenAI is releasing a new AI model capable of performing some human-like reasoning tasks, known internally as Strawberry. The company says it can handle complicated math and coding problems. Let's discuss with our tech reporter Annabelle Drewlers in Hong Kong. Belle, so is this sort of a new level of AI capability?
Well, that's certainly what OpenAI is saying. I mean, it's a very competitive market out there in this space. You've already got the likes of Anthropic, Google, for instance, saying that their advanced AI tools have some of these capabilities. But this is certainly the type of development that OpenAI will be hoping will continue to give it an edge in the space as well. As you said, it's known internally as Strawberry. It's called O1 externally, but the company says that it can perform some reasoning tasks. Now, just to give some context on reasoning in the computing sense, you're essentially talking about human-like intelligence being applied, where the tool can sift through different sorts of inputs or different sorts of knowledge and then use reasoning to derive or determine the accurate answer, or what it determines to be the accurate answer. So the system is now going to be available to select OpenAI customers, and the company says it's also going to be working on regular updates and improvements as well to the tool.
What about the user experience?
This could be a little bit different from what you've come to expect, because I'm sure a lot of people have already tried ChatGPT in some capacity, and you're really used to putting in your question and then getting an immediate answer. The company's saying that this is going to be a little bit different now. You might see a bit of a pause even for a few seconds, and that's because in the background, OpenAI says the model's going to be considering different prompts and then, again, coming up with what it determines to be the best response. And so that sort of technique is known as chain of thought prompting, rather. Who is it for as well? Something to consider, because OpenAI has given a lot of different examples of the model's response to questions on its blog post or on its website. Things like coding, English, math. It even asked it to solve a simple crossword puzzle. But as well, we've heard from one of the research scientists at OpenAI as well on Twitter, Noam Brown, and he's saying that the company is releasing it now in preview mode to get more of a sense of how people are using it and where sorts of adjustments are needed. But certainly it is a step forward for OpenAI, because they have been working on multi-step actions for some time.
And of course, in order to power all these AI capabilities, you actually need very powerful semiconductors, right? And in China, the focus on two prominent chip makers. Can we see some possible listings?
Yeah, that's right, exactly, because, of course, NVIDIA's chips underpin a lot of this technology, and it has been that real question in China, given you've got those restrictions around exports of some of the most advanced NVIDIA chips. They need to be able to develop their homegrown champions, and so we're hearing that two of the most prominent in this space could be looking at listing in Shanghai as soon as this year. So this is all according to our sources, but there's Enflame, which is looking to raise up to $280 million, and then also Biren, and both of these could be looking to list on Shanghai Starboard. The Starboard, of course, has been a friendly venue to companies if they've got that sort of high growth or fast growth startup, even if it is loss making. Biren as well, we're hearing, could be looking at listing in Hong Kong if those sorts of talks or that process for Shanghai bogs down. But both of those could be looking to file formally and list or debut as soon as the end of this year, early 2025, also possible. But as we said, that focus in China, Beijing, really pushing companies locally to develop and support and adopt new alternatives to the likes of NVIDIA, and it could be that Enflame and Biren are looking to take advantage of investor appetite around these names as well.
Annabelle Drewlers there in Hong Kong. Coming up on the Asia Trade, Societe Generale joins us after they downgrade China's GDP forecast for this year from 5% down to 4.8%. A little bit later on, we'll also be hearing from SGMC Capital on their Fed cut bets. Plus, Malaysia's Investment and Trade Minister will be with us to discuss the country's growing role in the tech supply chain. This is Bloomberg.
Take a look at how Japanese assets are setting up for the equity market opens. The yen is strengthening a little bit towards that 141 level. We're talking about strength for the past 4 consecutive sessions and really headed towards that 140 level very slowly. We also got comments from another BOJ policy board member that there is a need to raise the rate to at least 1%. We saw the Nikkei gaining ground for the first time in 8 sessions. We're seeing not a lot of movement in the futures market. We'll be watching the JGB's market as well because they were pressured yesterday from soft demand in a 20-year auction. And of course, it's all ahead of the BOJ rate decision next week. Just over half of the economists surveyed by Bloomberg expect the Bank of Japan to hike rates again in December. And when it comes to the move next week, really the survey showing that none expect any moves. Our senior editor, Brian Fowler, joins us now here in the Tokyo studio. So really, is going to be a boring meeting, or what should we be watching out for?
No, Shery, never boring, never boring. But yeah, there's no decision, no change in policy next week is almost certain. And that's consistent with what we've heard from officials in recent weeks. They've pretty much telegraphed their intention to continue watching to see how the economy and markets react to the July 31st hike. So that means there's no hike next week, but attention will fall on what comes next. And the survey shows that 2/3 of economists expect another hike by the end of the year. As you said, just over half see that happening in December. Another 15% says it could happen as soon as October. So Governor Ueda will have a chance to talk about what he sees in terms of inflation trends and the outlook, and that's going to be a huge focus. It's going to be very exciting, so don't worry, we'll have plenty of news next week.
It's always exciting here in Tokyo, but given that we continue to hear from these board members about the need to continue tightening, I think yesterday we had a very interesting comment as well.
Yeah, so board member Naoki Tamura, he's one of the leading hawks on the board, so take it with a grain of salt there, but he made some very interesting comments. He said that the neutral rate is at least 1%, the neutral rate being the rate where policy is neither restrictive nor stimulative. And he also said that the policy rate needs to be taken to at least 1% by the second half of the current projection period. That's a 3-year span. The second half of the current period would begin in October next year and go through March of 2027. So he's saying that rates need to be that high sometime between October next year and spring of 2027.
Oh, wow. A lot of clarity there. More.
Yeah.
Brian Fowler, our senior editor, and Haidi, remember when the BOJ meetings used to be boring back when?
Certainly, there's always room for surprise when it comes to the BOJ, right, these days. But speaking of central banks, Shery, of course, watching for China, and we've learned that China's poised to cut interest rates on more than $5 trillion of outstanding mortgages as early as this month. The move could help reduce borrowing costs for millions of families and spur consumption. For more, our China correspondent Min Lo joins us out of Hong Kong. Well, that's a hope, isn't it, to spur consumption, to boost confidence, to revive animal spirits in this very dispirited market. Could it have that impact?
That's right. So we previously reported that China has been mulling possible mortgage rate cuts, a total of 80 basis point cuts in 2 steps. And what we're hearing now is that banks are already making preparations for a rate cut. And what this could do, we're hearing that the first stage could be as high as 50 basis points. So this shifts the timeline up for mortgage rate cuts because banks typically don't reprice their mortgage rates until January of next year. So although China has already cut mortgage rates to record lows this year, it doesn't benefit most homeowners. It benefits the new homeowners, but there's still a disparity between existing mortgage loans and new mortgage rates. So that disparity is about 80 basis points. The mortgage rate cuts will erase that difference. And what this does is it is estimated to save consumers about $300 billion yuan annually in interest rate payments, and that could translate into retail sales of about 0.6% and GDP growth of 0.2%. That's assuming, though, that these consumers take all the savings in their interest rates to spend in the economy rather than just leave them in the bank. So this is the ceiling of the impact of this mortgage rate cuts. But the other thing that it does is it would eat into profit margins of banks, which is already at record low of around 1.5% as of end of June, and that's far below that 1.8% threshold that is deemed necessary for reasonable profit. So this is essentially the banks being asked to carry out national service. It's a wealth transfer from the banks to consumers.
But I mean, that's been the problem, right? I mean, it doesn't matter what the banks do. Really, Chinese people have not gone out to spend. That demand has lacked. And I guess we're going to see more indications of that with the activity data out tomorrow.
Yeah, so the activity data is not looking promising. We are expecting weakness across the board with fixed asset investment, retail sales, industrial production is leading the declines according to economists' consensus at 4.7% in August versus 5.1% the previous month. And if you look at retail sales, that's expected to grow at 2.5% versus 2.7% the previous month. Property investments, negative 10%, slightly better than the drop in the previous month of 10.2%. But again, this is worrying because in August, we were expecting a boost to retail sales because of the summer travel season. So even that is not enough to offset the broad weakness that we're seeing here. And also you have bad weather that could have weighed on industrial production and disrupted construction activity. But what is most critical is that fixed asset investment is also falling. And traditionally, we have seen government-led investment really supporting the weakness in private investment. But now we're seeing that support weakening because of slow fiscal spending. The issuance of special local government bonds is now at its slowest pace since 2021. So that is also a matter of concern. And you have President Xi appearing on CCTV, on state TV yesterday, saying that you're calling on officials to really properly implement all the policies for the third and fourth quarter to hit that growth target for this year of around 5%. And this comes as economists are shaving off the growth forecast for China. The consensus is 4.8% this year.
Bloomberg's China correspondent Min Min Lo there. More ahead on the Asia trade. This is Bloomberg. This is the Asia Trade. Some of the other stories we're following today. Donald Trump has ruled out more debates with Democratic nominee Kamala Harris. He says their first debate was moderated with a bias against him. Harris's odds of winning the presidency have risen following the showdown, and she is calling for another face-off. Meanwhile, the DOJ says Russia, Iran and China are increasing attempts to stoke divisions within the US ahead of November's election. A senior US official has warned European allies that Chinese companies are increasingly involved in boosting Russia's war economy. Biden administration officials are touring European capitals to share information with partners about China's cooperation with Russia and the potential implications. Beijing has rejected these accusations. More ahead on the Asia trade. This is Bloomberg. Boeing union members are voting on their first comprehensive labour contract in 16 years. It sets the stage for a potential strike as the plane maker works to recover from a series of manufacturing mishaps. For more, let's bring our Global Business Asia editor, Peter Verco. So there's been, as you say, a series of challenges for this company. What do we know about this latest scenario?
Yeah, good morning. So as you say, union members are voting later tonight, US time. We'll probably get a result sometime after about 3 p.m. Hong Kong time on this latest contract hammered out over the weekend. The sort of feeling at the moment is that workers are going to reject this offer, even though it was negotiated by their union. It's a 25% pay increase over 4 years, but workers were looking for more. They wanted around 40%. It also eliminates an annual bonus. And that's made them angry as well. So the feeling is that this pay contract or pay offer could be rejected, and that would lead to an immediate strike at Boeing's factories from midnight.
How has the new CEO dealt with this? Because we have heard that he would be based in Seattle, that he would really be closer to the plants and to its employees. What's the outlook look like for this new management when it comes to really controlling the ongoing crisis at Boeing?
Yeah, well, he's really been thrown into it feet first. Kelly Ortberg only started at Boeing early last month. And clearly this is among the many issues they're facing, this is probably the most immediate one now. He has been seen on the factory floor. He's been quite vocal in asking union members not to strike. He said that's a path where no one wins. He did make an appearance in the negotiations over the weekend. He's very keen to avert a strike. Boeing can't really afford this at the moment, not just from a financial point of view, but from a manufacturing point of view. Everything that's happened to them this year that really sort of started when they had the blowout on that Air Alaska plane earlier this year. It's just sort of been a rolling cascade of crises for them, and this is one that they really need to try to avoid at the moment.
Global Business Asia editor Peter Verco there. Now, sources tell Bloomberg that Jack Ma-backed Ant Group is refinancing an offshore credit line of about $6.5 billion. The move comes as the once dominant fintech company expands its global operations and seeks to recapture some of its lost glory from before a government crackdown. For more, let's bring in our chief North Asia correspondent, Stephen Engel, in Hong Kong. And Steve, it's been more than 3 years since that Ant IPO was halted. How significant is this move?
Absolutely significant if they want to come out, and appeal to global investors. Because, again, it's been nearly 4 years, in fact, since that Ant IPO was scuppered in the last second, of course, and then the regulatory crackdown began, and it was restructured, and then now essentially being regulated in China as a financial company, not as a freewheeling tech. So, again, they want to kind of position themselves globally as the Chinese economy is slowing down. They've expanded, Alipay Plus international payment systems throughout Southeast Asia. And again, they want to further expand beyond the shores in a slowing economy, of course, here in China. But also, I'm guessing that they would probably also want to position themselves more on the tech side than the fintech side, because again, the valuations right now, as we've seen with the Magnificent Seven and the rush to AI, the valuations are a lot higher, of course, on the tech side. So what can be the tech offerings, and where in AI can they make a difference? Now, the news we're getting overnight is essentially sources telling Bloomberg that offshore credit line, they're refinancing an offshore credit line of $6.5 billion. Ant International will be allocated $1.5 billion of that borrowing quota. And again, in March, Ant set up independent boards, keep in mind, of its international, its database, and digital technology units to pave the way for future spin-offs. It's building out that Alipay Plus and also with a package of AI services. And again, this is where it sees its future going forward, a global company with AI intentions.
But if they want to rebuild their earnings on the back of the AI boom, how critical is it for Ant to be able to build out these tech offerings?
Absolutely critical, I would assume, because, again, the valuations favor the tech side of the fintech equation. And I'm just looking at some of the things that they are offering. They're seeking essentially more avenues of growth in tech. Alipay, we all know it's ubiquitous across China. Zhifubao, it's known. It has 1 billion users, right? But again, it's being more regulated as a financial company in China, following, of course, the largesse of its lending units, Huabei and Jiebei. which essentially were dismantled by the Chinese government. So what they're doing now is they're rolling out something called a life assistant, Zhixiaobao. Not Zhifubao, but Zhixiaobao, which basically helps users navigate and hail taxis, order meals, book tickets, and other services across the Alipay platform. So again, they want to build that out and build their large language model, which has been approved by the Chinese government, into this life assistant to kind of channel users as well, those 1 billion users of Alipay, into these other tech services.
Chief North Asia correspondent Stephen Engel there. The latest on the corporate front, and General Motors is said to be in discussions to buy EV batteries that would use technology from China's Societe and be assembled at a new plant set to be built in the US. Sources say the factory would be funded and operated by Japanese firm TDK. They say the deal could change depending on the outcome of the US presidential election in November. Millennium Management is looking to raise between $7 and $10 billion of new capital in a new structure aimed at giving a firm more permanent sources of cash. The firm is taking a page from private equity firms and raising money that's callable rather than taking it in all at once. The new iteration allows clients to make pledges that Millennium can tap over time, Shery.
Heidi, take a look at how we're setting up for the opens across Asia. We had a very positive day in the previous session where we had the Kospi seeing the best day in about a month and the ASX 200 also gaining more than 1%. Right now, Sydney futures are pointing up to 0.6%, while Nikkei futures are also pointing upwards of 0.3% after already rising for the first time in 8 sessions. Of course, we'll be watching how the Japanese yen really behaves in order to see if these gains could be sustained, because we're seeing again strength towards that 141 level against the US dollar. A Bank of Japan board member now talking about the need to raise the interest rate to at least 1%. But it's really about global central banks, right? Led by the Fed. They appear to finally be wrapping up a hard-won victory over inflation. But winning that battle has also exposed the limitations of their approach, especially against challenges such as climate change. The Bloomberg Originals team takes a closer look.
In a way, the COVID pandemic and the inflation that followed has been a Wizard of Oz moment for the Fed and the ECB and the Bank of England and other central banks. There's a famous moment where Dorothy's dog, Toto, pulls back the curtain and reveals the wizard to be just a man with a loudspeaker.
The lockdowns of the pandemic caused severe supply shocks as factories shuttered around the world. Meanwhile, government stimulus meant to keep the economy afloat drove a surge in inflation.
We thought they were maestros, all-powerful geniuses. Central bankers were slow to recognize that inflation was taking off, and after it did take off, they didn't have the tools to bring it quickly under control.
When they decide they had to make this course correction by raising rates rapidly, they did go for it. Powell was very clear that they will do whatever it takes to bring price stability back. I think right now, many people thought that the Fed has redeemed themselves.
But at the same time, the world has changed.
We're living in a world which has swung from globalization to deglobalization, and where climate change is a new and important factor. We now live in a world of hot wars, Russia invading Ukraine and turning off gas supplies and oil supplies for Europe, an expanding conflict in the Middle East.
The Fed's policy tools can only raise or lower aggregate demand. It is not meant to affect supply in the economy. What can affect supply in the economy? Well, fiscal policy can, tax policy can.
So there's a big debate underway about what new tools are required to control prices and keep inflation low and stable, and many of those tools are being built outside of the remit of central banks. I think in the future, we're not going to be talking about maestros. Central banks have won the battle to get inflation back to their 2% target. In the years ahead, we may discover that they have lost the war over how management of inflation works.
You can watch the full Bloomberg Originals documentary now on the terminal and on Bloomberg.com. More ahead on the Asia trade. This is Bloomberg. All right, take a look at how we're tracking when it comes to currencies. Of course, a lot of questions when it comes to the direction of the euro, which has been sort of underperforming for much of this year. But of course, with some caution from Christine Lagarde potentially setting up against that dollar weakness, maybe for an outperformance, depending on what we get in terms of these expectations of consecutive moves from the ECB. Taking a look at, of course, what we're watching when it comes to dollar yen. And so much of this is coming down to what we could potentially get from the BOJ. In the latest survey, over half of BOJ watchers now see a next rate hike coming in December. This sort of really stunning rally may have taken a little bit of a pause recently, but it is still sort of ongoing with that 141 level at the moment. Dollar yen trading again a little bit weaker again with the broader equities backdrop there. Looking set for a fourth day of gains in this Friday session. But of course, the outlier when it comes to some of that strength that continues to be China. We'll be watching the yuan as well in terms of the potential yield twist from the PBOC, as well as these expectations of some leniency on mortgage rates as well. We're also getting the August activity data on Saturday. Bloomberg Economics sees more signs of slowing in that economic recovery. Our next guest has downgraded her China GDP forecast for 2024 from 5% to 4.8%. And says the growth outlook remains challenging. Michelle Lam is a Greater China economist at Societe Generale. Michelle, the fact that perhaps we're seeing Beijing, resigned, if not willing to abandon that 5% target, depending on what we get by the end of the year, does it tell you that there is a level of comfort knowing that this is kind of, in a lot of ways, a structural slowdown that the economy had to have?
So, of course, the government set this year growth target to be 5%. So if we are not able to achieve that, of course, there's going to be some negative impact on the confidence. But I think, to be honest, this is also the more realistic of the actual picture. Because we know that one of the major reasons that the GDP has been quite disappointing is actually the infrastructure investment. So even though the government has budgeted 1 trillion special CGB bonds to support the infrastructure spending, year to date, we look at the infrastructure capex is just growing at around maybe 3% to 4%. So that's definitely not enough to support the overall economy to reach 5%, given that the consumer spending is really struggling because of the property slowdown. And we know that actually the local government have been suffering from the decline of the land sales of nearly 20%. So if we do not know that, we don't know that when the property sector will really stabilize, but there's definitely downside risk. So without acknowledging that, I think it's actually more realistic for the government to maybe temper the growth expectations a little bit. So we also downgraded our GDP forecast this year for 4.8% to reflect that.
At the same time, though, even this week, we heard remarks from Xi Jinping in a seminar calling on all levels of government, from local to provincial, to try and hit that growth target, right? Do you think that is a useful conviction? And to that end, will we see local governments in particular, doing all sorts of things to try and hit this single number?
So I think the phrase that he put it actually is compared to what we saw in the July Bloomberg meeting. I think it's kind of somewhat just to try to hit the target, but maybe not as a strong of a wording compared to what we saw in the July Bloomberg meeting. So I think there's still a chance that China has not actually always met the GDP target. For example, in 2014, that year's growth target also missed the growth target maybe by the 0.1 percentage point. So I think there's still some risk that we may miss that.
What does that mean for the Chinese currency? Because we have seen quite some strength this quarter, up about 2% or so against the U.S. dollar. Could this strength continue, or given all of the economic implications that you're talking about, we could see more weakness from here?
So a couple of weeks ago, of course, we see the CNY appreciating quite notably because of the increasing expectations of the Fed cuts, and also it seems that there's some exporters converting the US dollar into CNY given this change of the expectations. But having said that, the sentiment actually changed pretty quickly because, for example, over the last couple of weeks, we got some pretty negative data for August, and I think that also has helped to change the sentiment a little bit. So I think it is possible that when the Fed starts to cut interest rates later, people's expectations could be shifting a little bit for the CNY. But I think if you look at the fundamental story of China, it is still in a structural slowdown. The debt deflation downside risk is actually rising, so that I think there's also more urgency for the PBOC to cut interest rate to support the economy. So even though the interest rate cuts may not be as big as the Fed, I think the negative interest rate differential remains pretty wide, and also there's a question of if the exporters, they are converting their dollars to the CNY. Actually, where will they put the money in, given that the investment returns are so low in China right now? So I think that our thinking is that it is still going to be quite some structural depreciation pressure for the CNY. Probably it will be strengthening a little bit against the dollar when the Fed starts to cut, but we think that it will continue to underperform other Asian currencies.
And it's not just the Fed, right? I mean, we've already seen the ECB, BOE, BOC cutting rates. So when it comes to the transmission mechanism and the impact into the Chinese economy, not only from the monetary policy side of things, from the moves of central banks around the world, how much are you factoring in what happens in those economies, especially given that China is an export powerhouse?
So, for example, when you look at the export data for August, it was actually a pretty decent momentum still. So I think there are some concerns about growth or even a soft landing or even recessions in the US, in Europe. And actually, this is not what our house view. We think that actually we could be seeing some slowdown in the US economy, but it's still going to maintain a pretty decent growth of 2% next year, which is slightly below potential, but not something that is a very dramatic slowdown. So I think that will still remain supportive of the export growth outlook for China. But I think the question here is, though, the downside risk is that, we do not know who is going to win the election in the U.S. in November. So if we have Trump, that's going to be it could mean more tariffs, and that would pose downside risk to China's exports. And on the other hand, actually, we've seen some front loading of exports to the U.S. from China earlier this year. So we do not know how much of the extent is the front loading, but it's also possible that we could be seeing some reversal of that going to later this year in the fourth quarter or even in 2025. So I think we're going to see still a pretty healthy export growth, but it's not going to be as strong as we see this year. So I think that also means that hitting an unchanged growth target for next year for China, say if growth target remains 5%, is really going to be a big challenge.
Michelle Lam, good to have you with us. Greater China economist at Societe Generale, of course, as we head towards the activity numbers out of China this weekend as well. We do have an alert on the Bloomberg right now. We're hearing that Carlyle has decided to take Standard Aero public. This is according to people speaking to Bloomberg. We knew that Carlyle was trying to sell the aircraft maintenance services provider, but we're hearing that Carlyle has decided to pursue an initial public offering because the bids that were submitted this week value the company below what it's expected to reach in a listing. We're hearing from people that Carlyle could also consider or reconsider if they received any improved bids for the company. But for now, they're considering taking Standard Aero public. We have more ahead on the Asia trade. This is Bloomberg.
And of course, Shery, we're setting up for a very interesting couple of months when it comes to global politics, right? And of course, we heard from, I guess we can take it as confirmation, although we know that there's always room to change his mind. But Donald Trump, the Republican candidate for the presidential election, saying that he's not interested in doing another debate. Of course, he's been quite vocal about sort of his narrative that the debate that he held with Kamala Harris, that the moderating, the questioning was biased against him. He says when a prize fighter loses a fight, the first words out of his mouth are, I want a rematch. He's saying that polls tell him that he won that debate. But of course, we know that there was a real boost when it comes to Harris's prospects and certainly, you know, market expectations following that debate. But Donald Trump has ruled out appearing at a third debate. He posted this on Truth Social on Thursday. So that, I guess, in some sense, sort of, you know, removes a little bit of uncertainty for the market in the immediate sort of pathway going into November too. We saw a CNN Snap poll showing that viewers broadly thought that Harris performed better and that odds of winning the election has sort of improved. But of course, a lot of this will also come down to policy. You mentioned earlier just some of the intense pressure when it comes to dwelling costs, when it comes to housing at the moment in the context of what we're seeing with the broader inflation picture in the US.
Affordability to own a house in the U.S. really at the lowest levels in years. We're talking about 2016 levels or so. No wonder that this is really becoming a key issue when it comes to the elections in the U.S. And of course, another election that we're following here in Japan as well. And campaigning has started for the September 27th LDP presidential election. And what a race. We have 9 candidates giving opening remarks. Really, this is a large number for Japan. And you can see that we were really struggling to fit all of them on that board. But very interesting, the diversity there. 2 candidates under the age of 50 and also 2 women running. Of course, the public doesn't necessarily get a say. It's lawmakers deciding on their leader. But given, of course, that the LDP is a ruling party, they're assured to become the next prime minister. We'll be following that race as well as the market opens in Sydney, Seoul, and Tokyo. That's next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens. After a broad rally on Wall Street, we had U.S. producer prices, Haidi, rising slightly in August, but not really changing the view that we are going to get a rate cut next week from the Fed, finally in sync with other major central banks like the ECB that cut rates again.
Yeah, we're of course also watching for that Chinese domestic activity data due out over the weekend, that sort of weakness expected there. Also, Shery, I suspect, particularly in your part of the world, watching some of these chip makers, given that we have had that news from OpenAI with their new AI model capable of doing some level of reasoning.
Yeah, and of course, in order to power artificial intelligence, you really need those very advanced semiconductors, many of them that are in the Japanese and Korean markets. Of course, take a look at the Nikkei gaining more than 3% at the open. No, take a look at the open now in Japan. It rose 3% in the previous session. Is really not doing much at the early start of the session. The topic's actually down 0.3%, but it was a big rally yesterday because it was the first time that we saw Japanese stocks gaining ground in 8 sessions or so. A lot to do with the function of the Japanese yen, which continues to strengthen against the U.S. dollar. Of course, we had comments again from another BOJ board member talking about the need to continue raising rates. This time, his comments were a little bit more specific. He was talking about a potential 1% level. But take a look at JGBs as well. They were pressured in the previous session because we had a soft 20-year auction. But it's really the all-encompassing view of what will happen with central banks and where the BOJ goes next week, because it's really what happens next. all economists surveyed by Bloomberg this time around saying that the BOJ will not move next week. So we're watching what the U.S. dollar does, because take a look at how South Korea is opening as well, because we have seen a lot of volatility in the currency space. We are seeing more strength against the U.S. dollar at this point. A little bit of divergence again with the tech-heavy Kosdaq, with the Kospi losing about 0.1%. But we'll be following those semiconductors very closely, of course, because of OpenAI news as well, Heidi.
Yeah, a key story to watch there. And Shery, take a look at how we're kind of just strolling into the open here in Sydney this Friday session. A little bit of an upside there when it comes to the ASX 200. This is that staggered start to trading, though. So we'll give it a bit of time to really kind of take hold. But certainly we're watching some of the gold producers after we saw that spike when it comes to gold prices again. So watching some of the miners today as potentially some of the big movers. The Aussie dollar holding pretty steady at 67.25. The big question is really kind of euro dollar and whether that sustained sort of dollar weakness continues. And of course, with that Saturday domestic activity data dump out of China, watching to see if some of these Australian China proxies see much of a reaction there as well. Treasuries, it was interesting, we had that 30-year auction tailing despite the sell-off into that bid deadline. Of course, that response to the CPI numbers and the view that maybe they would be kind of taking their cues from the dot plot rather than the rate cut itself, given how well priced that bet already is. Also watching Australian bonds at the moment. We have seen kind of a mixed open ahead of that futures expiry. But interestingly, some of the data just crossing the Bloomberg suggesting that Aussie bond sales have already hit that yearly record. We're seeing a lot of Asian money spurring that boom into issuance in the Australian market. And just lastly, watching oil markets as well, given the volatility we have had across commodities more broadly, and of course some of these concerns when it comes to the sort of supply side issues out of China. At the moment, Brent crude is actually holding a little bit more positivity there. And in fact, as a broader market, oil is set for that first weekly gain in a month. Some of that risk on tone, of course, down to Hurricane Storm Francine there as well. Let's bring in Max Bondurri now, who's a founder and CEO at SGMC Capital, for some of his views. So, Max, it's a funny sort of market we're in at the moment, right? Clearly, we're sort of firmly watching the Fed, also watching the BOJ as well. There's politics mixed in as we head into November. What's your gauge of how September is going so far, given it is, you know, historically not a great month anyway?
Well, definitely a lot of action with central banks, and politics will remain at the forefront. But central banks will be the main things to watch. Yes, we have not had a great start of September, but it is getting better. And it's not because September tends to be negative that it has to be negative also this year, especially if we look at the movement we've had on the US markets on Wednesday, whereby after an inflation data which was roughly in line and even a little bit higher than expected, Nasdaq opened lower, was about 1% lower, and then actually closed 2% higher. That actually shows the fact that you will always are going to be getting buyers when valuations become attractive. Because yes, growth is slowing down in the US, but it's also not falling off a cliff. And therefore, when you get some of these high growth names, whether in the semiconductor space or in the cybersecurity space, but overall in the tech space, that fall to levels where investors see it attractive, you are going to be getting that purchasing mood coming in. And we've seen that happen exactly on Wednesday. And that's why in the short term, that is going to be a very supportive move for the markets. Of course, waiting for the Fed until next Wednesday and see exactly what kind of commentary they're going to be saying.
How much of sort of the more interesting trades at the margins are going to be on rate divergence and discrepancy, right? Because it feels like at the moment we saw the move from the ECB and these market expectations on the Fed, and of course a handful of other central banks that have already started easing. It feels like there's some jostling for position here.
Well, there is definitely some jostling, especially because expectations have been moving quite a lot. Just think that beginning of the year, people were calling for 8 cuts. In June, they were calling for maybe 0 cuts. And now we're at 4 cuts from here till the end of the year. So there is room to play. And of course, one way in which to play it is through the FX market. So clearly now, markets expecting 4 cuts in the US from here till the end of the year. We don't see that as likely. We've been saying since last November, actually always, that we're going to get 2 or 3 cuts this year. So if that does happen, then part of that dollar depreciation that you've seen happening over the last few weeks, that is likely to be undone. Not the entire part of it, clearly, but part of it could happen. And for a tactical trade of going long dollar versus some of the other currencies could actually play out. And on the fixed income side, clearly, whenever you see moves which are overly excessive in magnitude, when the rates maybe fall a bit too much because, again, of overly dovish expectations, then there's clearly something to play there as well.
When it comes to the PPI numbers overnight from Wall Street, it was really interesting to see that shelter costs continue to push higher, really, really sticky. One of your overweight calls is upgrading the real estate sector. So where in the world are you looking at real estate, and what's the conviction behind it?
Well, the reason why we like real estate is quite simple. So clearly we know that rates are going to be coming down, and they will be coming down. But on the real estate, once they actually do happen, you're going to get that bit of a momentum in addition, because people are going to be looking at remortgaging, people are going to be looking at real estate even a bit more from an actual practical view. So that's why it's a little bit different with respect to the rest of the market, with respect to when things happen, with respect to expectations. Now, at the same time, you're looking at valuations which are very cheap. As compared to what they were just a few years ago, from a financial markets perspective. And those cheap valuations also allow you to lock in some attractive yields of some real estate properties. So do we like the real estate? Yes, we have gone overweight the real estate sector about a month and a half ago, and we keep on adding. In terms of areas, the US we clearly like, but the way we played it is through a diversified exposure across different sectors. So within the real estate, you're looking at a bit of residential, you're looking at a bit of the office space, and you're looking especially across states and cities in order to really get a diversified exposure to a theme and a sector which is going to be supported here for the next at least 6 to 12 months.
Is real estate still a thing here in Japan? I mean, it's operated in such a different way when it comes to the Japanese economy, given, of course, the decades of deflation that this economy has suffered. Now we have the BOJ playing a different game and the Japanese yen seeing potential risks to the upside as well.
In Japan, it is a different game, also because if you look at the central bank, it is playing a totally different game with respect to the other central banks. So Japan would not be one of the areas where we'll be adding real estate. You are in an environment where interest rates are increasing. You're in an environment where the currency is facing a lot of volatility, of course, appreciation over the last few weeks. But in general, this volatile environment is going to be staying. This is not a very suitable and ideal environment for real estate investments. Therefore, Japan would definitely not be one of the geographical areas where we would look to add.
Max Bondurri, always good to have you with us, CEO at SGMC Capital. Take a look at some of the early movers and a big move in Korea Zinc, gaining more than 20% at the moment. Of course, we had news that MBK Partners and Yangpung jointly launched tender offers to buy Korea Zinc shares between September 13th and October 4th. This was according actually to a notice posted in newspapers. They're seeking to buy about 1.5 million shares, or 7% of the stake at 660,000 won per share. Now, this price is about 19% premium to yesterday's closing price. So we are now seeing this tender offer jointly launched by MBK Partners and Yangpung, leading to the stock to jump more than 20%. Also, we're watching those chip makers across the Asian trading session. We heard that OpenAI is releasing that new artificial intelligence model. Of course, you need advanced chips for that. We're also following TDK, General Motors, according to people familiar with the matter, in discussions to buy electric vehicle batteries that would use technology from China's CATL and would be assembled by a new plant slated to be built in the U.S., but the factory would be funded and operated by TDK. This is Bloomberg. Boeing union members are voting on their first comprehensive labor contract in 16 years. It sets the stage for a potential strike as the plane maker works to recover from a series of manufacturing missteps. Aviation reporter Danny Lee joins us now with the latest. And Danny, I mean, we continue to see this series of problems for Boeing. How serious is this latest potential strike?
Well, we're just hours away now from a union result on whether to accept Boeing's offer not to strike, to accept a historic contract, which includes pay raises of 25% and an immediate pay rise of at least 11% straight away. But the feeling is that there will likely be a strike. This contract will be rejected by the union workers. You know, they've not had a contract for 16 years, and so there's a lot of pent-up anger, and especially around the deal that was presented to the unions that was negotiated by the leadership and between Boeing. So this will be critical because this has a huge consequence on Boeing's potential future production, given the crisis it has been through, particularly around manufacturing, its quality issues, and clearly the cascade of crises it has had since the start of this year.
Kelly Ortberg only took over in August, right? And he's stressed his intention to reset that employee relationship and to change the culture. But he's also, you know, sort of urging employees to choose what he says is the brighter path. Is he managing that relationship well, do you think?
I think you can sense that Kelly Ortberg's fairly active involvement, having been to the union negotiations earlier on. He has also spoken out in terms of, you know, asking the workers to accept this contract. So clearly he has a better sense of knowing what is at stake here and the fact that he wants this deal to go through. But clearly, you know, this is the biggest piece on the agenda, the immediate issue for Boeing to resolve, because, you know, from here on in there is still a whole host of issues that Boeing has to navigate and for Kelly Ortberg to confront. But if we do not see an acceptance of this contract, the key thing is whether workers vote to walk out, and they still need a 2/3 majority. And if that doesn't happen, the contract is enacted.
Tell us a little bit about those most pressing issues for Boeing to deal with right now, because, of course, we continue to hear about these quality issues in different jurisdictions. But what does the CEO need to deal with first, aside from this potential strike?
Well, clearly the resolution over this strike, because if there is rejection, there could be potentially more cost if it means Boeing has to offer more. Then you have other issues in other divisions, things such as Boeing's space ambitions. Clearly there has been challenges around that. There is also still a federal investigation underway. And then also just fundamentally how they manage to see themselves out of this oversight of regulation around safety and quality that it's being put under, particularly around its commercial manufacturing of aircraft, because that is its key cash driver, and it's limited at the moment. So how Kelly Ortberg can manage that as well is going to be a challenging one. But you need workers for that, and if the workers are not going to be paid enough, then we'll have a rolling series of issues that he will have to deal with over the next several months.
Our aviation reporter Danny Lee there with the latest on Boeing's challenges. Well, OpenAI is releasing a new AI model capable of performing some human-like reasoning tasks, known internally as Strawberry. The company says it can handle complicated math and coding problems. Let's discuss all of this with our tech reporter, Annabelle Jewellers in Hong Kong. So, Belle, do we need to be worried about this new level of AI capability?
I think it depends on which side of the fence you're sitting on, but certainly they are saying that this is a next leg, really, in the development of AI models. That's what OpenAI is saying, because it is, as we know, a very competitive market in this space. You've already got the likes of Google, Anthropic, that say that their advanced models also have some reasoning capabilities. But again, this sort of development, OpenAI hopes that it gives it an edge here. So as you said, it's known internally as Strawberry. Externally, it's actually called O1. The company, again, going back to your point around the concerns of what exactly it can do, the sort of power it provides, provides, well, it can do reasoning tasks, and reasoning in the computing sense. So essentially you're talking about human-level intelligence being applied, so the tool can sift through different sorts of knowledge, different sorts of inputs, apply human-like reasoning and examine different possibilities, and then give what it determines to be the accurate answer. So this system is now going to be available to select OpenAI customers, and then the company says it's going to use that user experience to then push out further updates and improvements.
Tell us a little bit then about the user experience then, at least in the beginning. What is it supposed to look like?
It will perhaps shift a little bit. So the company's already saying this. Of course, many of us will have trialed ChatGPT or a ChatGPT equivalent at some point over the last couple of years, and you're familiar with that input of a question or command, and then you get a pretty much instantaneous response. OpenAI is saying that now people may need to just pause or wait for a few seconds, because in the background, the model is going to be trialing or considering different prompts and then coming up, again, with what it determines to be the most reasonable response. So that's a technique in computing that's known as chain of thought prompting. Who is this for? Well, it's already got a lot of different applications, OpenAI says, including coding, English, math. It was even able to solve or ask to solve a complex, or simple rather, crossword puzzle. But certainly, as we said, this model is sort of the first iteration, and OpenAI is going to be, again, using the experience of its user base to then carry out upgrades to it, but they certainly have been trying to get computers to carry out multi-step actions for some time. So this is, as we said, a step forward.
Again, renewing the focus on chip makers and supply right in China. There's a special focus on two prominent chip makers. Could we see some listings ahead?
That's what we're hearing from sources. So yes, given you've got all of that focus on the computing power and the compute readiness, it puts a lot of burden on the chip makers like NVIDIA, of course. China is restricted from accessing some of the most advanced technology from the likes of NVIDIA, and so it is that push to develop their homegrown chip champions. Now we're hearing that two of the most prominent ones could be looking at listing as soon as this year. So there's Endflame, which could be looking to raise up to $280 million, and then Buren, which is Tencent backed actually, and both of those could be looking to list on the Shanghai Star Board, which is a venue that's been very friendly to high-growth startups, even if they are loss-making. Buren, we're hearing as well, could look at Hong Kong as a destination if the Shanghai process bogs down. But we are hearing, again, all of this from sources that they could be looking to file documents this year. They could be looking at eyeing an IPO even within 2024, possibly early 2025. But again, it is that focus in China of developing, supporting homegrown chip champions, and part of that also entails investor appetite for these new domestic players.
Annabelle Jewelers in Hong Kong there with the latest on OpenAI and, of course, semiconductors. Right now across Asia, major semiconductor names losing ground. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at how European stocks are opening when it comes to the futures session, of course, after the ECB and also after sort of some level of ambiguity being transmitted by the ECB and by Christine Lagarde as to whether we could see consecutive cuts there, offering really no clarity on what we get as the ECB continues to really wait for its own data to find answers there. The data will really kind of shape how drastically the economy is deteriorating, how that shifts the inflation picture. But it did, of course, lower the key deposit rate by a quarter point for the second time this year. We are seeing broad upside when it comes to risk assets in Europe trading in the future session.
And really, Heidi, it was the moves in the European space that actually had an impact in early Treasury moves. So we actually saw the 10-year yield advancing slightly towards that 368 level, still below that 370. However, in the Asian session, we're seeing a little bit of recovery in the Treasury space. So we're now seeing yields falling across the board. That's also affecting the dollar, which is now being pressured. On the other side of that trade, you have all of these Asian currencies, and you can see really that upside being felt on the Japanese yen, for example, headed towards that 141 level. We've already been seeing that rally in the yen. It's now heading for the biggest quarterly advance in years. And Bloomberg opinion columnist Daniel Moss now thinking that the yen's rally is perhaps a lesson in currency intervention. He joins us now. Dan, I mean, we've been talking about how Japanese policymakers came into the market, intervened with billions of dollars, but that didn't necessarily move the needle. But you're saying that perhaps we're not giving them enough credit?
Yes, look, there tends to be this market fundamentalist view, which I encountered repeatedly when I was responsible for Bloomberg's currency news in London in the early 2000s. And that view was like mantra: intervention doesn't work. Well, you know, the point I'm trying to make here is that depends on what your objective is. And you can't look at it based on what happens in that day or that week of trading. So let's back up a bit. The yen has had an enormous rally this quarter. If you go back and look at the points at which Japan intervened, or which roughly, when you look at the monthly data, correspond with official fingertips type moves, you can see that they picked their shots pretty well, and in at least one instance intervened overnight in the US after a specific set of economic data pushed the dollar down generally. They then got on the back of that. So the Japanese taxpayer got extra bang for their yen.
I like it when you talk about there has to be an element of mystery, Dan, but there's also got to be an element of, really clear communication, right? Would this have worked if the Fed hadn't have pivoted, but also if clear moves from the BOJ hadn't been flagged? And could it still fail if UEDA fails to deliver?
Yeah, look, it needs to be seen in its context. It is an ingredient, and it needs to interact with other things that are going on at the time. Now, let's go back to late 2022 when Japan intervened against yen weakness for the first time since 1998. They announced that. They wanted everybody to know that they were there. They were banging the gong. In the several instances we've seen this year, they were very careful not to talk. They let the monthly accounts do the data. Now, the risk is UEDA shows less conviction on the rate hike path this Friday than he did in July. Then bets could be off.
Our Bloomberg opinion columnist Daniel Moss there. More ahead on the Asia trade. This is Bloomberg. Bloomberg opinion columnist Mohammed El-Erian thinks markets lack a dominant economic view. That's after we saw, of course, swings in US Treasuries following Wednesday's US inflation report.
So we saw a 20 basis points round trip in the 2-year. 20 basis points. That's a lot for that maturity. And we learned two things. One is that we have excessive data point dependence. All that happened yesterday in the inflation report, as people know, is that monthly core came slightly harder than expected. Everything else was aligned, and yet we moved 10 basis points up. And then we discovered a second technical, which is money on the sideline being put to work quickly. And that, I think, is our reality, is that we don't have a dominant economic view, so we get swung all over. But the stabilizer right now is this technical of cash on the sideline. Now, financial conditions are good stabilizers with two very important qualifications. They are volatile, and they have as much perception as reality. So we are going to continue with this volatile world until we restore either a dominant economic paradigm or we restore the power of forward policy guidance.
You could argue that even in the face of all of this volatility, it shows how strong the economic system is, that there wasn't some sort of significant disruption. Isn't that sort of the ultimate stress test, that when the benchmark rate swings around by 20 basis points, you don't see any massive selling? Why is it more pernicious than it might seem on the surface?
So I do think the financial system has been strengthened, and in particular the banks. And we are in a much better place than we were in the past. So you don't get the massive balance sheet effects. You don't get the sort of virtuous cycles, good or bad, that can happen from that. But don't forget that we are the benchmark for the rest of the world. And we cause quite a few spillovers that the rest of the world says, you know what, enough now. We've had enough of this. Please get your act together.
Mohammed El-Erian, Bloomberg opinion columnist and University of Cambridge Queen's College president, speaking with Bloomberg's Lisa Abramowitz. Take a look at how broader Asian markets are trading a little bit right now, because we're seeing some downside broadly, and the Nikkei now down 0.3%. The Kospi has managed to recover from losses, but it's still slightly higher, 0.2%. We're seeing really some of those big chip names leading the declines in the Asian session today. We're talking about the likes of SK Hynix being down more than 2%. Also, Samsung Electronics down more than 1.8%. In the Japanese session, Tokyo Electron recouping some of those earlier losses, but still sitting pretty much unchanged. Malaysia has been positioning itself as a global tech supply chain hub, with the country hosting a number of chip packaging facilities for firms such as Intel and Global Foundries. Joining us now exclusively is Zafrul Aziz, the Malaysian Minister of Investment, Trade and Industry. Minister, great to have you with us. Welcome to the program. I just want to start asking you about this whole tech sector and the semiconductor side of things, because we continue to see, of course, the geopolitical tensions building up between the U.S. and China. Is this having any impact on your economy, on how you operate in this sector?
Right. Well, first, thank you, Shery. Well, we know, as we navigate through this tech war, I mean, it's the global trade war, but it's really, to me, the challenges are facing the tech industry. But we're talking to companies, and companies are telling us that they are realigning and redesigning their supply chain. And so as a result, we've seen more investments coming to the region. Malaysia, of course, has been a net beneficiary of that. And Malaysia has been in this industry for more than 50 years. We built a strong ecosystem around the semiconductor industry, and has been a major part of our exports. So to me, when we see what's happening today, many companies in Malaysia, both Malaysian companies and international companies in Malaysia, are seeing better results as a result.
Could that change depending on how the U.S. elections unfold in November?
Well, honestly, when I see what has happened in the last 5 years, even during the change from Trump to Biden, we don't see major changes in this sector for Malaysia, for Malaysian companies, and also for the international companies based in Malaysia. And I don't foresee that continues to change when there is if there is a new policy change in the new U.S. administration.
The US has been stepping up curbs when it comes to Chinese chip makers, right? Has that affected Malaysia, and how do you try and navigate this?
Yes, well, to date, it has not affected. What's key is we continue to engage both China and US. Of course, Malaysia is a very open economy. We are parties to many multilateral and bilateral FTAs with many nations around the world. So the key is to continue to engage. To date, we have not seen any tariff being imposed on companies based in Malaysia in the chip or in the semiconductor sector.
Perhaps one of the challenges is building up a skilled workforce, right? What are the strategies to counter some of the concerns that Malaysia doesn't have that adequate workforce to be able to realise these, chip investment ambitions?
I think you're right. One of the major challenge for the industry, and this is not just for Malaysia, but also globally, is talent. The talent pool required for the growing semiconductor industry has been quite demanding. So for Malaysia, we have been working very closely with industry. We have programs such as Academy in Industry. It's basically a work-based learning program where we work closely with academia and industry to have skill set being upgraded, or we have reskilling as well. So basically it's a course where employees will get paid, and after that will get permanent jobs with the companies. But what's important is we're skilling people according to the needs of the industry.
Minister, of course, you're in Hong Kong right now for major events, including Invest Malaysia, including Belt and Road initiatives as well. Tell us a little bit about what sort of companies globally you're targeting for them to come over to Malaysia. And how far along are the conversations in these negotiations to bring them to your country? And anything exciting that you could disclose today?
Well, I've been meeting investors, both capital market investors as well as FDI investors. They're talking about various sectors that they are interested in. And we, of course, have been focusing on 5 key sectors that we want companies to come to Malaysia and invest in Malaysia, especially in the digital and green sector. We are looking at 5 key sectors, as I mentioned. We are looking at the E&E sector, the digital economy sector, chemical, petrochemical, healthcare, especially on medical devices and pharmaceutical, as well as the aerospace industry. So these are the 5 sectors that we've been talking to the investors in Hong Kong, based in Hong Kong.
So that's some diversification there, I think. How important is it, do you think, for Malaysia to be able to not have all its eggs in the AI basket, given the questions over investment and, the correlated returns? Is that a concern, do you think?
Well, that's why if you look at where we are today, we do not just focusing on E&E, particularly semiconductor. I mentioned that we are also in various other spaces that we have focusing on today, aerospace and chemical, petrochemical being 2 out of the 5 that I mentioned earlier. We have a very diversified economy. We have a commodity-based economy as well, still strong. I mean, 20% of our exports is commodities, and the other 80% is in the manufacturing and services sector.
Minister, really appreciate your time with us. The Malaysian Minister of Investment, Trade and Industry, Zafrul Aziz, there with us. More ahead on the Asia trade. This is Bloomberg.
Sources tell Bloomberg that Jack Ma-backed Ant Group is refinancing an offshore credit line of about $6.5 billion. The move comes as the once dominant fintech company expands its global operations and seeks to recapture some of its lost glory from before a government crackdown. For more, let's bring in our chief North Asia correspondent, Steve Engel, in Hong Kong. And Steve, of course, this is huge after the halted IPO more than 3 years ago. What do we know at this point?
Well, we do know that Ant has ambitions to regain some of that past glory that you just outlined. Keep in mind, it was nearly 4 years ago when that world-beating IPO that was going to be in New York as well as here in Asia that valued the company at about $280 billion or thereabouts. Last year, when the company essentially repurchased shares from investors, they valued the company at about $73 billion. So it is a much smaller company, forced to restructure and also be regulated as a financial company rather than a tech company in China. So they've been trying to find their footing by using their core app, which is Alipay, Zhifubao, which has international payment capabilities. And they've been expanding into Southeast Asia in particular with cross-border payments with Alipay Plus. Now, they want to further expand their international presence and footprint given the slowdown in the Chinese economy, obviously, and that's where this news comes in about the refinancing of about $6.5 billion line of credit. This, according to sources, an international division of Ant Financial or Ant Group will be allocated $1.5 billion of the borrowing quota. And again, we also heard, keep in mind, back in March, this company basically set up independent boards of director of its international division, its database division, as well as its digital technologies units to pave the way for future spin-offs. So, yeah, absolutely. They want to recapture some of the investor appetite, even though there's no IPO necessarily in the cards for any of these divisions. They want to kind of emphasize the tech part of that fintech and use AI.
We're talking about what was once the crown jewel, right? Not just for Alibaba, but for China Inc., really. In order to be able to get back there again, does it really need to build out these tech offerings?
It really does, because obviously it became much more of a financial company in its heyday with micro lending. That's a misnomer. There were some large sums being involved with Jiebe and Huabei, the two big lending units that were supposed to be microfinancing, but they became the biggest revenue contributor to Ant. And that was one of the big reasons why that IPO was scuppered, and then they were going to be now regulated as a financial institution. Now, as we've seen with the Magnificent Seven, with NVIDIA and others, and AI boom, if you want to get the attention and a loftier valuation, you need to have these tech offerings, and AI is key. And one of the offerings it is building out is its so-called life assistant, Zhi Xiaobao. So Alipay is Zhi Fubao. This is Zhi Xiaobao, which basically allows users to use an AI and the large language model that Ant has and been approved by the Chinese government to basically help users buy tickets, just do daily necessities through the Alipay platform. And that is one reason how they're trying to use their AI capabilities, nascent as they may be, to build out the tech side of fintech.
Our Chief North Asia correspondent Stephen Angle there on the return of Ant Financial. Let's take a look at broader markets at the moment, particularly when it comes to the currency side of things. Of course, this yen strength / dollar weakness really continuing to hold and driving what we see as some gains across these markets as well. But the dollar index poised for a 9th week of losses out of the last 11 weeks. And we continue to see really that rate divergence story continue to play out as well, with the latest economic data really not sort of moving Fed expectations one way or another. Really, the dilemma is still the scope of that cut ahead, and watching some weakness there when it comes to trading in the dollar versus the Chinese yuan as well. Bloomberg has learned that China is poised to cut interest rates on more than $5 trillion of outstanding mortgages as early as this month. The move could help reduce borrowing costs for millions of families. The idea is that that would then spur consumption. For more, our China correspondent Min Min Loy joins us. And so, we did hear from Xi Jinping in the remarks made in a seminar, really wanting local and provincial governments to do what they can to meet that 5% growth target. Is this going to be able to have the intended impact?
Yeah, well, what we're hearing is that banks are preparing for an adjustment of the mortgage rates of up to 50 basis points, although we previously reported that there could be a 2-step cut of up to 80 basis points in total. And this is projected to save consumers, or rather homeowners, about 300 billion yuan in interest rate payments annually, which then translates into 0.6% in retail sales and 0.2% in GDP growth. But again, the caveat there is that the model, the economic modeling there is based on the assumption that all that savings is translated into spending. But we know that given the current environment, many homeowners might just keep the additional savings in their banks, because of all the fears around income growth and job security. And right now, China has already cut mortgage rates to record lows, but that only benefited the new homeowners. So this existing mortgage rate cuts will benefit the new mortgage rate cuts rather will benefit existing homeowners. As you can see on the screen, there is a discrepancy there of around 80 basis points between the average mortgage rates of existing loans versus new loans. So the mortgage rate cut certainly will go some way to maybe help consumers feel that they can reduce part of their precautionary savings there.
Yeah, will they spend is the big question, especially now that we have upcoming public holidays in China as well.
Yes, so we have 2 big holidays coming up, the Mid-Autumn holiday in September and then the Golden Week holiday in October. And that's where, economists are watching very closely how the consumption recovery will look like, because that gives us a barometer of overall sentiment. And Bloomberg Intelligence is saying that any surprise to the upside will be good for sentiment. And so far, the early data, pre-booking data that we have seen suggests that travel demand is up above pre-pandemic levels levels and also above the Dragon Boat Festival holiday earlier this year. But the key question is per capita spending. Will that go up? Because we're seeing this consumption downgrade story. So if you look at the chart there, consumer staples have been really lagging behind their peers. It's down 22% year to date compared to an 8% decline in the CSI 300. So stocks to watch are, the travel stocks, Air China, Trip.com, likely to benefit from the travel season. We're expecting some sportswear brands to benefit from the sequential spending season back to back. You have the September holiday, the October holiday, and then the November Singles Day spending shopping festival. So that might boost the consumer stocks there. And also your entertainment stocks, box office, likely to benefit from some new movies set to be released during the Golden Week holiday as well.
Bloomberg's China correspondent Min Lo there with the latest on the Chinese economy. As we continue to watch, also Hong Kong's commercial property slump dragging on. Chinese state money, though, has emerged as one of the few pillars of support. Mainland firms have become active buyers in the city's flaming real estate market. Bloomberg Intelligence senior analyst for Asia Pacific real estate, Patrick Wong, joins us now. And Patrick, we are seeing Hong Kong tycoons not wanting to sink in more money in Hong Kong properties, foreign funds not coming in. So why are more Chinese buyers more encouraged about Hong Kong land?
We think that is very interesting situation that we have lots of Hong Kong developers. They also struggling quite a bit. That it trigger potential the property price coming down a bit further. It's already coming down since a couple of years ago. For office, it's down 40% already, and then residential also down almost 30%. So that's why we observe that some Chinese state developers, right? We observe China overseas land, China resources land. That could be some potential opportunities for them to grab the opportunities here in Hong Kong, especially potential. I think in the past they buy office, they buy residential. Potential, it could also go to shopping mall as well.
How does this impact property prices in Hong Kong?
I think the property prices in Hong Kong already coming down quite a lot. So if we see more buyers coming back to Hong Kong, especially some state-owned developers coming in, potentially together with the interest rate cuts, which may happen very soon, this will also bring some support to the Hong Kong property market. And that is also a good opportunity for lots of Hong Kong developers to sell some of their assets.
Yeah, tell us a little bit about how that would really support those developers in Hong Kong that have been really battered by years of property price declines.
The challenge for them is it's more difficult to sell. So you see, until recently, early this year, we have the stamp duty relaxation for the buyers, overseas buyers, so attract more demand coming back a bit. But it's more for residential. For commercial market like office, retail, the market is still very tough. So it makes the situation that for lots of Hong Kong developers, they also getting the liquidity challenging. Especially now we see what happening is the market is tough, and then some of the developers, like we see recently, newer development, they issue a bond at relatively high coupon rate, over 8%. So we see the liquidity is a bit challenging. So that's why they really want to sell some of the assets to raise the cash and also liquidity.
Bloomberg Intelligence Senior Analyst for Asia Pacific Real Estate, Patrick Wong. More ahead on the Asia trade. This is Bloomberg. Take a look at some of the big movers when it comes to Asian gold stocks that we're watching. Broad upside as expected going into the start of trading. We're about an hour into the session across Sydney and Seoul as well as Tokyo. We're seeing the likes of Evolution Mining, Regis Resources up by as much as over 6%. Gold pretty steady at the moment when it comes to stock prices in Asia, but it did spike almost 2% to a record high in the Thursday session. We saw traders really adding to positions ahead of next week's Fed meeting. We are expected to to see that beginning of a rate cutting cycle. But we are on track when it comes to gold for a weekly advance of more than 2%. That is the most in about a month there. And we did also see that sharp move higher after the ECB cut rates for a second time this year as well. The broader inflation and jobs data supporting the case for lowering borrowing costs in the US. So that's kind of the broadest picture. But we have seen gold, in terms of zooming out to what we've seen this year in price action, a surge of almost a quarter this year. And again, it is that growing optimism towards Fed easing expectations. Shery.
And given those expectations, really not surprising, Heidi, that we are seeing that rally in Treasuries resume in the Asian session. We had seen it halted for the past 2 sessions, where we actually had 10-year yields advancing a little bit, but that's not the case right now in the Asian session, which is also pressuring the dollar. So we are seeing the dollar now fall. On the other side of the trade, of course, you have the Chinese yuan as well, strengthening a little bit. The Japanese yen also strengthening towards that 141 level. And you can see right there, U.S. futures not doing much, but TAIEX futures pointing to the upside. And of course, we are headed towards Chinese activity data over the weekend. A50 futures didn't do much, but we'll be watching that data out of China for really a hint of where the economy is headed in that side of the world. That's it from the Asia trade. Our markets coverage continues. The China is next. This is Bloomberg.